Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The bulls reclaim more lost ground. The Sensex gains over 600 points. The Nifty moves back above 23,000. Mid-caps outperform with the index gaining over 2%. Maruti Suzuki meets estimates in Q3. Revenue up 16%. Profits rise 13%. Margins contract due to discounts even as it remains ahead of its peers like Hyundai India. ITC Hotels lists at a discount of nearly 31% from its implied share price after the demerger. The listing price is in line with analyst estimates. The stock hits 5% lower circuit. Analysts estimate a passive outflow of over $165 million as the stock moves out of the benchmark Nifty and Sensex. CNBC-TV18's Newsbreak is confirmed. The Cabinet approves a 16,300 crore rupee mission to develop 24 critical minerals over the next 6 years. The Cabinet also clears the ethanol price, leading to a rally in sugar stocks. After Rashtriya Ispat Nigam, the government may adopt a strategy to revive select PSUs that are financially weak. Sources say the government is not in favour of banks taking haircuts. Fund infusion, mergers and consolidation are some of the options on the table. Many people feared dead and several injured after a stampede at the Mahakumbh in Prayagraj in the early hours this morning. President Murmu and Prime Minister Modi expressed condolence. Opposition accuses the UP government of mismanagement. The state is yet to provide details on the number of people dead. The Trump administration gives federal workers time till February 6 to make a choice: return to office full-time or resign and get paid till September. This comes days after Trump's executive order on a return to office mandate. The U.S. government also made it clear that even employees who choose to stay on may eventually bear the brunt of downsizing. After a prolonged decline due to the pandemic, students are making a modest recovery on learning outcomes, according to the annual Status of Education report. But a majority of children in Class 3 and 5 are still unable to read a Class 2 level text or solve simple math problems. Well, let's start with the market action. It was a day of recovery on Dalal Street. We saw some broad-based buying, and that helped the markets gain for the second day. The Nifty reclaiming 23,100. The Sensex up 630 points. 76,533 is where it closed. The Nifty Bank higher by about 300 points. And it's a 2.5% move up on the Nifty mid-cap. Remember, the Nifty mid-cap as well as the small-cap index has been beaten down quite significantly. But today, a recovery underway as far as the markets are concerned. But staying with market-related news, the MCX has also announced that it will remain open for normal trade on the 1st of February in light of the union budget. Remember, both the NSE and the BSE have already said that they will open for normal trade on the 1st of February, which is, of course, a Saturday, but it is the day of the union budget, and so the markets will be open on Saturday. Now, the U.S. Fed commenced its two-day policy meeting yesterday. This is its first policy meeting in the second term of President Donald Trump. The latest Fed survey by CNBC highlights that 65% of respondents see 2 rate cuts in 2025 and 61% forecast at least 1 cut in 2026. On Trump's tariff threat, 77% of the respondents see it as a negative for inflation, while 73% said it is negative for growth. 55% believe that Trump's deregulation agenda will reduce inflation, while 68% said it will boost growth. And you can catch the coverage of the Fed meeting from 11 p.m. onwards right here on CNBC TV18. In earnings, auto major Maruti Suzuki's third quarter numbers in line with street estimates. Net profit rose nearly 13%, revenue up 16% on an annual basis. Margins contracted on the back of discounts despite being ahead of peers like Hyundai India. And Mahindra Sudarshan standing by now to take us through Maruti's report card. Sud.
So if you talk about the earnings, Maruti's Q3 earnings were absolutely in line with estimates. But the question is, why did the stock fall? If you take a look at the stock performance of this month in January 2025, Maruti shares have moved 10% higher, and it has outperformed peers M&M and Hyundai. Shares of M&M and Hyundai were down 9% each. So what all the factors have worked for Maruti in Q3? First, raw material prices have stabilized in last few months, and that seemed to have helped margin positively. Second, volumes have moved higher both sequentially and year-on-year. Sequentially, it was up 5%. Year-on-year, it was up 13%. Third, realization, or can say average selling prices, have fallen. That have seen a minor fall, but it has come in line with estimates. Second, margin has fallen 30 bips sequentially, but it has outperformed Hyundai. Now, talking about the numbers, profit was up almost 11%, or say 13%. Revenue has increased by 16%. EBITDA was up 14% and margin has been above the levels of 11.5%. It has come at 11.6% versus 11.7% in the same quarter last year. Now the question is, what exactly we would be expecting in the commentary? First, what does company say about the demand? Second, if there is any change in the outlook for FY25. Remember, after Q2, company had said industries the outlook for FY25 is in the range of 3 to 4%. Will we see an uptick? Because if two-wheeler companies, both TVS and Bajaj Auto, have said that now the growth for two-wheelers in the range of 6 to 8% versus 6% it was in H1 FY25. Will we see the same thing for four-wheeler as well? So on earnings, it was in line, but all the eyes will be on demand outlook by Maruti.
Yes, most certainly. So many thanks for joining us and staying with earnings. Adani-owned Ambuja Cements posted a 17% year-on-year volume growth in Q3. Profits rose 242% year-on-year, aided by government grants and a sharp surge in other income. Revenues grew 13% along with total income that rose by 28%. However, margins have seen a sharp contraction compared to last year. The cement major also said that its board has approved an open offer to acquire up to 26% stake in Orient Cement. Well, it's time now for our special budget countdown with industry leaders. Finance Minister Nirmala Sitharaman faces an uphill task as she presents the budget on Saturday, the 1st of February. Now, there has been a clamour from India Inc. to hike the capex budget and review the new income tax regime slabs to boost demand. But does the government have the elbow room? India's debt to GDP ratio is at 85%, according to Goldman Sachs. It's the highest among emerging markets. There's also a fiscal glide path of 4.5% by FY26 that's staring at the government. Disinvestment receipts are likely to fall 50% short of the FY25 budget estimates. The subsidy bill is also expected to be higher by about 18% above the FY25 budget estimates. Now, as per FICCI's pre-budget survey, which was conducted across 150 companies between December and middle of January, the thrust on capital expenditure has been the key budget ask. Industry has pitched for a 15% hike in capex, a simplified tax regime and tax certainty topping the wish list. Well, to take the discussion forward, we're now joined by FICCI's President Harshvardhan Agarwal. He's also the Vice Chairman and MD at Imami. FICCI's Senior Vice President Anant Goenka, also the Vice Chairman at RPG Group. And with us on the program, FICCI Vice President Vijay Sankar. He's also the Chairman at the Sanmar Group, and Rashesh Shah, the former President of FICCI and the Chairman of the Edelweiss Group. Gentlemen, appreciate you joining us here on the program. Harsh, let me start by asking you, the big hope continues to be on the capex front. Anywhere between 15 to 20% is the ask from industry. What we saw last time around was a number of 11 lakh crores coming in from the government. The heavy lifting on capex, the expectation for industry is that the government will have to shoulder that responsibility. What else besides capex do you believe is the need of the hour today?
First of all, thank you, Shane, for having us here. See, as well, what we know, the government has been having a development and growth related budget, for the last few years. And what we expect as FICCI is the continuation of that. And in that continuation, as you said, yes, capex expenditure increase is one of the wish list, which from FICCI side we have recommended to the government. But apart from that, one of the biggest challenge, we are seeing the consumption slow down. So what does the government do to take care of that? How do they boost the consumption is something, what we would like to see in the coming budget. Apart from that, from the perspective of how do they further boost and help the manufacturing sector so that, the Atmanirbhar Bharat agenda of Make in India, how does the manufacturing industry, they get a boost. So things around that, is what are the most critical ask from our side and what we would expect to see in the coming budget.
Okay, Anant, let's take that forward. So two specific recommendations there from Harsh, more for the manufacturing sector and more to boost consumption. On both those fronts, let me start by talking about consumption. The expectation is that some relief for the middle class, specifically as far as tax breaks are concerned, some further exemptions and tweaks, some relief on standard deduction. But given the way that we've seen this government operate across several budgets over several years, how much are you are you betting on a significant tax relief coming in?
Right. I think we expect to see some tax relief, not a major overhaul of taxation, but I'd say something at the lower levels of the lower and middle income class to enhance some disposable income on their end is what we're hoping for. In addition, we had a thought of recommending a temporary issue of consumption vouchers, again, to the same class of lower and middle income with an expiry date so that there is further spurt of expenditure on their part. In addition to that, we felt that food inflation is a big area of concern. And here, I'd say the data at multiple points of what is impacting food inflation needs to be collected. A mission from the PMO side would be very useful with long-term and short-term impacts in terms of one is on the short-term on the logistics side, and in the long term, in terms of addressing supply side constraints to control food inflation would also help.
When you talk about these consumption vouchers, what's the amount and what is the expiry date that you're recommending?
We didn't have a specific amount in mind. I think that's for government to really look at balancing the fiscal glide path, and that's important that they maintain that. But based on what they want to do on the income tax side, as well as this, some kind of balance, and an expiry, again, possibly of about 6 months or so that in the near term, there is some amount of increased expenditure.
Anant, on manufacturing specifically, one of the key asks, of course, is, and the hope is that the concessional scheme will be brought back for new manufacturing units. That's what we're picking up on, that is something under active consideration. Whether it's a scheme with a 15% tax rate or an 18% tax rate remains to be seen. But how much will that spur this private capex demand from the government's end, which has, of course, been on the table for long?
Right. I think private capex I think once consumption is taken care of, hopefully that will result in higher private capex increase to a certain extent. I think there would be long-term actions which the government has continuously focused on should continue. The Jan Vishwas Act 2.0 is something that we are looking forward to. Maybe some study on the regulatory aspects. That's been a little bit of a challenge overall. And how do we balance between meeting its objectives as well as minimizing the negative consequences of over-regulation. So that balance becomes very important. And we think the China plus one opportunity with such an uncertain US government coming in, the issue of tariffs coming into China, can that be a great tailwind for India over the longer term as well? Manufacturing, we strongly believe, is maybe the number one factor that will result in job creation and spurring of the economy, and we believe strongly that that has to be focused on.
Well, that certainly will be something that the government will try and provide additional measures towards. But let me bring Vijay into the conversation as well. Vijay, manufacturing, consumption and deregulation. And I would imagine that perhaps the economic survey is going to be the one that weighs in on the regulatory aspect much more than the budget. But what are you going in with as far as expectations from Budget 2025?
I think as Harsh and Anand spoke, I think the key is the slowdown in consumption, which needs to be addressed in the short run. And in the medium and long run, the health of the manufacturing sector, especially given the huge opportunities that we're seeing post the US government and the China plus one opportunity. But there are some things to be done on ease of doing business, including cutting down the multiple slab tax rates, putting more money in the hand of the consumers. I think that is certainly a reason to, raising tax slabs, including perhaps the basic exemption limit at the lower levels. This would, ideally, these slabs should be adjusted in line with inflation, which will help protect the lower end, the earnings at the lower end, and put more cash in the hands of the consumers at the lower end. I think that is going to be extremely key. Otherwise, what we see is generally tax at most is taxed at the slab rates. All income is taxed at the slab rates virtually now. And it is, in our view, it is a little high. There's no easy answer. The government does have a difficult task with the FICCI. But, it is something that I'm sure the government will live up to industry's expectations.
Yes, Neelkant Mishra has left us with a number of about 80,000 to 1 lakh crore rupees. That's the headroom for the government to be able to play around to ensure that they stick within the fiscal parameters that have already been outlined in the budget. But Rashesh, let me come to you. We need the fiscal policy and the monetary policy to work in tandem to ensure that we continue to build momentum as far as growth is concerned. What do you expect on the fiscal side and on the monetary policy side? We do have an MPC meeting coming up. The expectation is that the MPC will move with the rate cut, but already the liquidity issues being addressed by the RBI with more liquidity enhancing measures being announced ahead of the budget. How much relief do you anticipate that's brought in?
Yeah, actually, it is actually very important because, as you correctly said, I think both the fiscal policy and the monetary policy have to work in sync. Last year, if you saw, because of elections and all, government spending on capex came down. It was not as high as expected, and we expected it to really start picking up in second half, but has not happened. So some level of fiscal looseness has not been there last year, as well as last year because of RBI intervening in the forex market and all. Even the liquidity conditions have been very tight. So both, we are hoping that fiscal opening up and the monetary is around us in the next couple of weeks. I do think it is very important for both RBI and the government to say we need to get to 8% growth. I think hovering at 6.4, 6.5, which is expected for this year, is not going to be good enough. We have to break out of this logjam that we have got in, and both RBI and the government will have to work in sync. I do expect that RBI to cut rates. RBI started working on liquidity, but even now, I think half the liquidity pressure has gone away. Other half is there. RBI also has some LCR norms that were supposed to kick in. I do hope they postpone them because that LCR norms will also crunch liquidity even further. So I think RBI should open up liquidity plus the rates coming down, because that will be a strong signal to say we are going for growth. And I expect the government also to say we want growth. Now, how do we get growth? Through capex and through consumption. For consumption, I think cutting rates, easing that whole thing, the ease of doing business, spending on capex, incentivizing capex from the private sector. Our view is that the private sector will start spending on capex once the consumption demand starts picking up. So I think that will be the key.
Yeah, perhaps easier said than done, Rashesh, because there's also a challenge and a dilemma facing both the Reserve Bank as well as the government, especially in light of what we're seeing happen as far as the rupee is concerned. Inflation continues to be above the comfort levels of the Reserve Bank. Growth is under pressure at this point in time. So really, when we talk about the expectation of a rate cut in the context of a depreciating rupee, how much room is there for the Reserve Bank to move?
So actually, it's a key thing. Is the rupee really depreciating or appreciating? Because if you look at the weighted average rupee, we have actually appreciated vis-a-vis our other competitors and other emerging markets in the last year. We have fallen vis-a-vis the US dollar, but against the basket of all currencies, we have appreciated. Some of our export competitiveness has gone down. Hopefully, oil price is inching down under the new US administration. I think drilling will go up. I would expect that oil prices will come down. So I think we may have a little bit of room. And I think, you can't have everything. So somewhere you'll have to let loose. And a lot of us believe that allowing the rupee a little bit more adjustment room might be the easier answer to get to 8% growth.
Ananta, how are manufacturers looking at what is happening as far as the currency market is concerned? And, there is, of course, one side that believes that it actually will enable India to be much more competitive. It aids our exports. But we've also got an interesting, commentary coming in from the Federation of Indian Exporters saying quite the contrary. So how are manufacturers looking at what's happening with the rupee, and what is the view from here?
I think it would vary sector to sector here because, there is an import component as well that comes in. So net, if you're a net exporter of products, it's better for you if the rupee is depreciating. But net, I'd say that there is not much difference that happens because in the end, we also import a fair amount of raw material. So it's about balancing that out. But overall, of course, it should aid imports as rupee depreciates against the dollar. Now, going back to the China plus one opportunity, if there is a duty imposed on China, then the US market opens up and the relevance of dollar rupee parity makes a big difference. And that can become a very large opportunity for Indian exporters over time. I think it is upon Indian entrepreneurs now to go out and look at those markets, solve customers' problems in global markets, and develop products for those markets as well. So some amount of the onus lies on us as well.
Absolutely. The Indian entrepreneur will have to be nimble and agile to make good of the opportunities, but we will also have to wait to see whether tariffs are imposed on India and across which sectors. It's a threat that President Trump has reiterated several times over already, not just on the campaign trail, but in office. But Harsh, let's talk about what's happening on the FMCG side. And, we've seen this tepid volume growth continue now for several quarters. Is there any green shoots visible at this point in time? And what are you attributing this consumption slowdown to primarily?
See, what we have seen that earlier, since last 2 years, in fact, rural was the area, where there was concern and consumption was slow. But now what we see is rural has come back, it's growing much better than the urban areas. And the real problem is in the area of, the middle class, the lower middle class, is where the biggest challenge is. If you see, the overall average retail consumption of Indian consumers, 75% of their spend goes in food and grocery. So which leaves them with only 25% to be spent on discretionary areas. So any inflation in food really have an impact on the discretionary spend. So the point is, how does the government help in controlling the inflation in food? Certainly will help in consumption to revive. Apart from that, green shoot perspective, yes, the inflation, we are seeing, the food inflation coming down a little bit. So going forward, yes, if it comes down further, then it will certainly help.
Vijay, let me end by asking you, any big ticket ideas that industry is expecting? Last time around, the focus really was on jobs by way of that internship scheme and so on and so forth. But anything out of the box, out of the usual that industry is expecting this budget to deliver on?
Certainly on the tax front, Shireen, and you alluded to it, I think extending, the incentives for new manufacturing investments is something that not too many people are speaking about. If that happens, it will certainly give one small kicker to private investment. More rationalization on the tax front. I think we are all hoping that the FM delivers more by reducing tax rates. I think that is something that I think all of us, whether it's industry or private individuals, all of us are looking forward to, Shireen.
Well, the FM did in the budget promise a direct tax overhaul, but that is more to do with simplification as opposed to rate rationalization. So we will have to see what more gets spoken of. But of course, the expectation is that some relief, whether it is by way of additional exemptions or perhaps even a change as far as the slab is concerned, in the 30% bracket, our understanding is that maybe that is something under consideration, but only time will tell, and we'll know on the 1st of February which way the finance minister moves the needle. Harshvardhan Agarwal, Anant Goenka, Vijay Sankar and Rashesh, always a pleasure. Many thanks for joining us here on CNBC TV18 with your budget expectations as we count down to the union budget. We will head into a break. There's a lot more coming up. Don't go anywhere. We're back in a moment.